Stefanutti Stocks was formed from the merger of Stefanutti and Bressan Stocks, Construction and Skelton Plummer. The group operates across all sectors of the construction business and has also recently established a presence in Dubai. It has a market cap of 1.7 billion rand, price to earnings ratio 8.2. I'm still looking for that double one, and a dividend yield of is at 1.1%. I'm almost scared to ask, are they any better than Robex?
I think this is probably the best in terms of quality that we're going to talk about tonight. The business was small Durban-based business, founded I think in 1971 by the chairman, who's still a significant shareholder in the business, as is Willie Myburgh. I think if you add their shares together, you get about 14%, which as management is fairly significant. I think the other big shareholder is Coronation, I think, if I'm not mistaken. I could be mistaken there. But I think in essence, because they've got a pretty good spread and they're probably the best that we're going to speak about in this little round here. Plus also they're aiming for about 30% public sector and roughly a quarter of their business outside of South Africa. And when I say outside of South Africa, you did mention the Middle East, but I think there's some exciting prospects in some of our neighboring countries. Angola certainly has attracted quite a few of these that we're talking about.
And we know what Angola is like to operate in. He's sounding like he's a little warmer towards Stefanutti. Where do you stand?
Yes, if you look at the balance sheet, they've got more than R1 billion of cash on the balance sheet against the market cap of 1.7 billion. And they're in a net cash position if you deduct the debt. So it does look quite good.
I do remember Avenge used to have more than R5 billion on that balance sheet. I don't know what it's standing now.
So maybe we should take a moment just to talk about one of these very exciting things called the accounting treatment of construction companies.
Please treat us.
Which isn't that exciting, but just briefly, construction companies work on a percentage of completion basis when it comes to revenue recognition. So they'll go out and decide how far they're on the project, and up until that point, they'll recognize revenue as a percentage of how much of the contract has been completed. You sometimes have a difference between what the company says they've completed and what the client says. And that difference, sometimes these companies like to show in the accounting statements, and then it's named...
They get clever accounting, financial engineering.
Yes, it's called uncertified revenue. So that's revenue that has not been certified. The client hasn't agreed that that's been completed, but the construction company still shows it on their books. So there's some concern that when you see revenue on a construction company, it's not really there. Secondly, the same with cash. Cash is a operating asset when it comes to a construction company. There's big cash in and outflows during the year for a construction company. So if you see R1 billion on the balance sheet, it's not necessarily R1 billion of free cash flow.
Or R1 billion in the bank.
Yes, so be careful between revenue and cash when it comes to construction companies.
So what are you saying about just Stefanutti?
That the free cash is not quite R1 billion, it's quite a bit less, but relative to their competitors, the cash position does put them in a much better position, and it allows them to accept much bigger contracts because the cash makes it easier for them to deliver on a contract.
Sasha, I was watching the graph of the previous company. We're looking at Robex, and I'm looking at this one now. Now, Robex one sort of ticked up towards the end. There was a small run there. Here, we're looking at a stock under pressure here, not reflecting notwithstanding the cash that he's talking about. That potential is on the
when they listed about 6-7 years ago, they listed at a much higher level.
And as lost you can money see, if you had stuck it in there.
100%. So unfortunately, it's been a bit rough for people in the sector. But I think in terms of quality, this is probably the best one that we're going to talk about. And also, I think that point that Jean-Pierre made about when construction companies record revenue, the cost variability inside of a project, how can you be sure if you're, typically if you're building a power plant, it's a multi-year project and things can change, as we know, which we've seen with regards to labor demanding more, plus also project delays. So the margins, I think group margins at the lot were like 1.8%. So it's problematic when you've got all these variable costs on longer dated projects.
I remember some of these guys had operating margins round about the 20s, and now we're talking about ones and stuff. But you mentioned the fact that they've got at least about 25% of their business outside South Africa, suggesting that a weakening in the rand would be beneficial for them. Now, I dare say, I don't know if that's such a good thing these days, because you watch the rand in the last week, over 3 days, and I was looking at this very carefully, the rand retraced 45 cents. So really, it's not a big advantage, is it?
No, I don't think so. And trying to predict currencies, gee, the
nobody
world
knows,
market, I think it's $4 trillion wash around daily. If you're in amongst all of that and you're getting it right, Godfrey, then you can stop this as a day job. But I think in the long term, I think a lot of building and construction companies here locally, which have had African footprints for quite some time. You know, some of these companies have got a 20-year history in places such as Angola, and because they got mining expertise here, they can leverage off, mining specifically. I think in the DRC, we're still in early stages. You know, our neighbours to the north, your homeland, you know, pretty early stages. But I think oil and gas is also going to be huge. So having, serviced Sasol as a client, some of these companies, I think they'll be able to benefit and show their local expertise, plus also probably compete on price better than a lot of the others.
Yeah, I see you disowning your homeland. Anyway, let's talk about it. Is it hot or not for you?
No, unfortunately, I don't
Again,
think
another
so.
not
the
hot.
group margin's too low.
Guys, you're wearing all purple here. What are you saying?
Well, I like the cash on the balance sheet. I like the acquisition of a pipeline business, like at pipelines that will help with oil and gas. So once again, not too bad, but as a sector, commodity industry, still for me, not hot.
Still not hot.